welcome to today's Advisor Investment webinar. Thank you for joining us. My name is Dylan Smith, for those that don't know me, and I'm the Senior Manager of Advisor Solutions here in the distribution team of Morningstar Australia. Just some housekeeping issues before we do jump into the webinar itself. I suspect that today's webinar will generate some Q&A. So if you do have questions, please submit them via the Q&A button in Zoom. This session is also currently sitting with the FPA for accreditation, and we expect their CPD points to come within the week. So when they do, you will receive an email, and as I say, that should be about a week or so. The other email that we will send will be a recording of this session, a summary video that you can share with your clients, as well as some of the notes if you'd like to pass on the key messages yourself. And so without further ado, I think we will jump straight into this webinar. So please allow me to introduce our speaker today, Jody Fitzgerald, Head of Institutional Portfolio Management and Solutions at Morningstar. So we expect to go for 40 to 45 minutes with questions afterwards. Jody, the floor is yours.
Thank you. Good afternoon, everybody, and thanks for joining us today. Earlier this year, we actually did a portfolio update webinar, which we titled A Once in a Decade Opportunity. We were back then really excited about the valuation opportunities that existed in the market. And today I'd like to give you an update on where we're at in our investment thesis, how it's playing out, and where we're actually at with regards to the overall journey. It has been a really extraordinary 12 to 18 months in markets. We saw one of the strongest and shortest lived market sell-offs in history. It lasted only 33 days, which was quite extraordinary. And now markets, at least at a headline level, are back to all-time highs. And if we look at, for example, using the US market as the example, the PE ratios are now back to pre-tech wreck levels. So currently a PE of 27 is basically what the S&P 500 was at back in 2000. Now, back in 2000, if we were to compare them, both the numerator and the denominator, so the P and the E, were rising. It was just that the P, so the price, was rising faster than earnings. But with the benefit of hindsight, what we know is that the rise in earnings was actually into a peak. When we have a look at what's happened in the PE ratio over the last sort of 12 to 18 months, the rise of the PE ratio has really come about from an implosion of the denominator. So price was running ahead of earnings. We're now entering what we refer to as the second phase of a typical recovery. We don't expect to see further PE expansion from here. Rather, we're actually expecting PEs to contract. And that's because we're expecting earnings to move ahead of price. Earnings will start needing to do the heavy lifting from here. Now, I know, and I think it would be remiss of me not to sort of point this out, that, over the last few years, a lot of assets has started to flood into passive type investments, some for fee reasons and so forth, but others just simply because the rising tide, it was fairly easy to make money in markets through passive investing. I think it's really important to understand that the bulk of passive investing generates its return from multiple expansion. So by virtue of the construction of an index, you get a higher exposure to stocks whose price have risen. If we're not anticipating multiple expansion from here, and I can say with complete sort of faith that if we do get multiple expansion from here, we should all be very, very nervous. Then from here, where the focus really needs to be on is earnings. And that is why active management from this point on is actually going to be really important. From our perspective, we're looking at areas in the market that we want to be exposed to things that haven't actually participated as ferociously in the recovery as other sectors of the market, and where earnings revision and yield normalisation will actually play a role. I presented this chart in our Q1 webinar, and we talked about at the time the significant dislocation between value and growth that was actually occurring. So at the time we were at this point roughly in the market where, so the blue line is the excess return of value on a rolling 12-month basis relative to the MSCI, and the orange line is the rolling 12-month excess return of growth relative to the MSCI. So last time we went through this chart, we were roughly at about this point, and we could see that the dispersion between value and growth on a rolling 12-month basis was the greatest it had ever been. So where are we now? And as you can see, over the last 12 months, we've had basically the start of a cyclical recovery. We know, and these red arrows are pointing to previous parts of history where there's either the market anticipating an economic recovery or a change in global GDP. We know that when the market starts to anticipate an improvement of the economy, that value stages a long-lasting and very strong recovery process. In about the fourth quarter of last year, when the vaccine started to be rolled out and economies started actually opening up, the market started to anticipate the cyclical recovery, and we started to see a rotation out of growth assets and into value. When you look at this chart though, this is a rolling 12-month basis, and some people might be saying, well, it's played out. Well, actually it hasn't. This is just the excess return over a 12-month period. What this chart is saying to you is that whether your value or growth over the last 12 months didn't necessarily impact your performance. Your alpha and stock selection certainly did, but you could have been in growth, you could have been in value and got roughly a similar outcome from point to point. Now, obviously, the ride wasn't as pleasant in growth portfolios. But we still think there's plenty of headroom because we know what typically should happen here is this blue line should shoot through and up. And when we actually have a look at the performance differential between value and growth on a rolling 3-year performance basis, you can see there is still plenty of headroom for value to do well from here. This chart is a chart that I also showed last time when we were running through the portfolio. And basically what it shows you is for our real return growth fund, the exposure to value as a factor. Last time we spoke, we were roughly kind of this point. We were very excited about the opportunities that the COVID sell-off had actually presented to us as a valuation manager. The market had started to shy away from anything that was cyclical in nature, and we saw huge price corrections. So for a contrarian investor such as ourselves, that was a huge buying opportunity. We had the opportunity to buy assets at valuations we just hadn't seen for 10 or 20 years. And we really lent into this volatility taking these positions. What that meant is that our conviction in value as a factor had gone up to the highest level it had ever been in the history of this product. You will note that recently it has started to come off a little bit, and that's predominantly because of the profits that have been made in some value positions. And as we've been locking in some of these profits, it has pulled back the value factor exposure a little bit, but we still are at, effectively close to all-time highs. Look, our process, and this shows you the performance. The yellow line is the performance of the Morningstar Growth Real Return model versus the blue line being the median manager in the marketplace over a 7-year period, which is the time frame recommended for this product. What you will note is that clearly our focus on avoiding downside risks, our seeking valuation opportunities and willingness to take contrarian positions has actually meant stronger wealth generation for clients over the time frame recommended for this product. But over shorter timeframes, we're very mindful of the fact that our performance can look really different to peers and to a naive benchmark. And we've had a few questions over the last 12 months with regards to the pattern of our return profile over the last year or so. So I'd like to take this opportunity to step you through that performance profile. So leading into the crisis, you will see here that we were concerned, you would have known that we were concerned about market valuations. As a result, we held a much lower growth asset exposure and a higher exposure to cash. So during this period, you can see the steepness of the yellow line is a lot flatter than the blue, representing the fact that the median manager was actually delivering stronger performance profile than what we actually were. However, once the crisis actually hit, we did exactly what we said we would do with client portfolios. We certainly did not draw down as much as the median manager. And that's indicated by the length and the drop in this section of the curve. Now, you often hear us talk about the fact that we want to avoid a permanent loss of capital. And by that, what we actually mean is that if you buy an asset that you know is above its fair value, so if you buy an asset for $200 that you know is only worth $100, when that asset reverts to fair value, chances are you may never make up that difference in capital. You're going to have to find somebody willing to buy that asset off you for $201, despite the fact that the market knows it's only worth 100. To us, that is what we're referring to as permanent loss of capital. However, we are comfortable taking short-term performance volatility in assets that are cheaper than their fair value, and we know the fundamentals stack up, and we're buying them with a significant margin of safety. As much as I'd like to say we're going to pick up an asset at its absolute low point in a cycle, the reality is that's just not going to happen. So coming out of the COVID crisis, and this is where we're getting a lot of questions around understanding our performance profile, we were actually leaning quite heavily into cyclical assets, in particular energy and financials. Now, those cyclical assets took a lot longer to find their bottom. We were dollar cost averaging into these positions. So what you can see here is this blue line being the median manager. His performance was a lot steeper during this part as the market was finding its bottom. And we were still buying into positions that were on a sort of, that were falling in value, but were significantly below their fair value with a large margin of safety. In the fourth quarter of last year, when it became obvious that an economic recovery was on the cards with the rollout of the vaccine, with economies starting to open up, you can see that rotation into value that we had significantly captured in the portfolio has meant that this yellow line, being our performance, has certainly been a lot stronger than the peer group. So one thing I would note is that if you look at the yellow line, our volatility relative to our own performance is quite modest. The volatility of the peer group is actually quite large, represented by the size of the peak to the trough diversion. So it's important, I think, to ask yourself when people refer to our performance, performance relative to what? Relative to the goals that you've set for your clients and to the objective that we've promised to achieve over that horizon? Or is it relative to a peer group or a naive benchmark? So what we'd say is this product has really sort of proven its capability over the last 7 years with regards to what it can deliver. So what I'd like to do now is actually get into, some of the positions that we've spoken about before and give you an update on where we're actually at in that journey. So one of the most compelling positions to actually come into the portfolio, it's been in the portfolio for a little while, but we've really ramped up our exposure with the COVID sell-off, has actually been energy. Now, energy was actually, and you can see here, so the light blue line is the MSCI World, and I've actually put on here the MSCI Europe and the US Energy Index. And I've separated them out for a reason, which we'll talk about in a moment. You can see that going into the crisis, energy was an underperformer relative to the global equity markets. Once the crisis hit, though, anything that was cyclical in nature, so anything that was reliant on economies being open, was severely punished. And you can see that from the peak at the beginning of last year, energy actually dropped by over 55%. Now, that provided a fabulous buying opportunity. Now, remembering that if an asset drops by 55%, to get back to square, it needs to return 120%. So you can see a lot of the upside that would be in that position. So you can see from the light blue line that the sell-off was fast, but the recovery has also been fast. And actually, from an overall market perspective, it is actually back well and truly above its COVID lows and is now back into profit territory. Oil markets, on the other hand, even though the fact that oil markets themselves are close to rebalancing after what has been probably one of the biggest demand shocks we've ever seen, and oil prices now are at a multi-year average and above the mid-cycle price. So they're at around $70 a barrel versus a mid-cycle price of around $55 that we have in our models. Despite that, you can see that neither US or European energy has actually fully recovered to their pre-COVID levels. So while the energy sector itself has delivered 58% returns for us from its March lows, it's still not back to its original position. So there's still some legs in this particular thesis. Now, the reason why I actually separated out the US and European energy exposures on this chart is you can actually see the recent divergence in performance that's actually occurred. And that's really important in understanding the way that we're actually evolving our thesis with regards to energy, and in particular where we're going to get our exposures on a go-forward basis. So one of the reasons why we've had a significant divergence between the performance of US and European energy stocks is predominantly because of the different exposures that they have to the oil market segments. US companies tend to be more exposed to upstream segment of the oil and gas industry, which includes things like exploration, production activities, onshoring and offshoring drilling. European companies, on the other hand, have larger downstream exposures. So this covers things like refining, basically turning oil into petroleum products, and the marketing, so the sale of those particular products. So when you think about it from this context, it becomes really clear that the US companies have been a better beneficiary of the recovery in oil markets, while the European players are actually more leveraged to economies opening up. We've been doing a huge research project as this thesis has actually evolved in understanding how we should sort of move our positions around. And the current focus is understanding these differences and where we see there's more to play out. So obviously from this perspective, the European players have more potential upside than the US players, given the relativity of the performance. The other segment, though, that's particularly important to understand is the impact of renewables and the varying business strategies on a go-forward basis. There's no doubt that as a world, as a society, that we are moving towards decarbonisation. The US and the European players, however, have very different strategies. US firms are investing more in their current businesses, and the main players being Exxon and Chevron have really minimal investments into lower emission solutions. So Exxon is currently having a $3 billion investment into lower emission solutions, which is a small part of their total CapEx budget of $20 billion. European companies have a very different strategy, with these businesses actually committing to zero net emissions by 2050. So at the moment, what we have is the big companies like BP, Shell, Total are spending as much annually on renewables than what Exxon and Chevron will be spending over many years. So at the moment, around 50% of the CapEx deployed in European companies is being deployed towards renewable projects. So while the exposure of the US versus European businesses is currently different, they're going to become even more different in the future. Renewables, I think it's important to acknowledge and identify, does have a lower expected return compared to oil and gas. However, by making the investment and getting ahead of future potential regulation, also being less exposed to carbon-intensive industries means that the European companies are more likely to have cash flow stability and sustainability going forward. Now, we've done a bottom-up sum of the parts valuation of these sort of major companies. And what you'll see here on the screen is the grey is a representation of the upstream, valuation of the upstream businesses, the yellow downstream, and green the renewables. We spoke earlier about the fact that upstream downstream relativities and how that's actually impacted performance of US versus European companies. So at the moment, upstream, you can see from here, makes up about 50% of European companies' valuation, whereas it's between 70 and 85% roughly for Exxon and Chevron. Now, given the lack of investment of US companies into renewables, the green part, there's no value assigned to that. However, the renewables business is somewhere between 20 to 30% of the fair value for European companies. What the red line on this chart actually indicates, where the red line intersects with the bars, it intersects at the current market value of those businesses. So what you can see from here is that using Shell as the example, the current market value is placing no value at all on the renewables business. So from our perspective, given that the European companies are more highly leveraged to economies opening up and the next phase of the recovery, and given the free optionality that we have in the renewables business, because you're basically getting the renewables business for free, we are starting to favour European businesses over US business and starting to rotate our portfolio to reflect that. So delving into sort of where we're at and how we've actually performed in these markets, since the March lows, European energy has returned around 60% in local currency terms, 40% Australian dollar terms. So while a portion of this valuation adjustment has certainly played out, there is significant upside, which we've already discussed because we haven't gotten back to pre-crisis levels. The integrated players have really improved their operational leverage since the 2016 oil price recession. They shed non-productive assets, right-sized their balance sheet, and most of these European companies have break-even energy price levels of, they're quite low in the case of BP, which we'll talk about in a moment, of around $20 a barrel. So they're profitable at low energy prices. So despite the fact, what I have here on this chart, so the orange line is the recovery of the oil price, which you can see is kind of well and truly back to where it was. The blue is the performance of European energy companies. So despite the recovery in the oil price, the benefit of that hasn't flown through to the European energy companies yet, where we're really waiting for economies to open up for that benefit to play through. One of the stock positions that we hold and that I covered in our last portfolio update session is BP. Now, BP, which we all know, they're an integrated global energy company with businesses across exploration, refining, delivering of products and services to customers. Strategically, they have shifted their business. They're shifting it away from oil and gas to sort of be that zero net emission target by 2050. What we know about BP is as a low-cost producer, being they only need $20 a barrel oil price for them to actually be able to cover their current CapEx spending requirements and to pay a dividend, that they're actually in a really good position where oil prices currently are. During the crisis, they focused on maintaining their balance sheet strength to ensure survival, so they did cut some of their dividend payments. Now, valuation, as we already mentioned, implies that you get the renewables business for free. So despite the fact that the stock has actually rallied and is still trading at a bit of a discount, there is still significant upside in this business. The chart here shows you the movements in the portfolio. So during this period here, which highlighted by my arrow in the green sections, these are periods where we were increasing our holding. So we increased after the initial sell-off. Then when cyclical companies continued to be punished, we picked up more, down towards the bottom. We have started trimming out of some of these positions, just taking profits on the way up, but still hold BP and see it as a good investment opportunity in the portfolios. So moving on to US Energy. US Energy has been a really strong performer. Since we initiated the position back in March 2020, the position is up over 100% in US dollar terms. You can see here the closer correlation between oil price correction and US companies. And that comes down to the upstream versus downstream exposure that we spoke about earlier. Look, there's a little valuation expansion from here. As I said, PEs have already run. Valuation expansion is not expected to be high. However, there's still total return to be made in these positions, mainly through dividends normalising and earnings growth associated with a better macro backdrop will actually drive returns from here. So within the global context of an opportunity set, so when you look across the opportunity of assets that we can invest in, there is still relative attractiveness in US Energy. However, we are seeking to take profits given the extent to which it has run. And an example of a stock that is actually held in the portfolio is Chevron. You can see here again, the green boxes representing times where we started to purchase the stock and dollar cost averaging in. When it took a secondary dip, we took the opportunity to get set in further into the position, and we have started trimming that holding now in the portfolios. UK was also a position that we gave an update on last time as well, so I just wanted to give you an understanding of where that investment thesis was at. The UK has actually done really well since its lows, but as you can see here, I'm comparing the orange line is the FTSE and the purple line is the MSCI World. So despite the fact that the UK is actually up 43% since its March lows, it still hasn't fully recovered to the extent that other global markets have. So the 43% means we have actually seen a lot of the valuation adjustment play out. However, it still offers one of the best forward-looking return expectations behind European energy in the market at the moment. And if you actually take an unhedged exposure, which we have, our expected return profile doubles because there's significant value in the pound at this point in time. So with PE expansion having played out, yield and earnings revision is really what's driving returns from here. But we actually think it's important to not just look at the UK as a whole, but to actually dig into particular sectors that we know will be quite, beneficiaries from the next stage of the cycle. And the areas that we have preferences in are things like financials, energy, obviously BP is a UK listed company, and various telecommunication businesses. The reason why we still see significant return potential here is that during the COVID sell-off, a lot of the UK companies made large dividend cuts. Now, as we start to see those dividends normalise, particularly in financial and energy companies, and you actually see a cyclical improvement in earnings, there is upside here, but it's important that we're keeping on top of changing the composition of the portfolio to best reflect companies that can benefit from the next phase of this recovery. A stock example that we ran through last time was Lloyds as a banking group. Now, Lloyds had a really good first quarter earnings report. Their net interest margin appears to be really resilient despite low interest rates. Now, the macro backdrop in the UK is starting to improve and is only expected to improve more from here. One of the things that all of the financial banks did leading into the COVID crisis was actually to increase their loan loss reserve provisions. Now, as the macro backdrop starts to improve, these businesses can actually reverse these loan loss provisions out. What that does is it actually drops straight through to the bottom line. So it results in immediate uplift in earnings. At the same time, UK was quite a unique example where the regulator instructed banks not to pay dividends in 2020. Now, this compares to the previous 5 year, where the average dividend paid by UK banks was 4.5%. So from here, the value is really a normalisation of that yield and an improvement in earnings as some of those loan loss provisions can start to be written down. I'll move also now into a similar position that we held in US financials. So as I mentioned, as we went into this crisis, we took up a large position in cyclical stocks, particularly energy and financials, and even what we referred to as some COVID stocks, which I'll get to in a moment. The US bank exposure has been really profitable. US banks have been up over 100% on average when you're looking at the bigger banks. And you can see that despite the fact that the yellow line being the S&P 500 has run a little bit harder, banks have started to really sort of close that gap off. We initiated holdings in around March, as the sell-off was occurring, and are in the process of starting to trim. Banks are beneficiaries of the cyclical tailwinds, and in particular, we've seen a significant steepening of yield curve. Now, it's really hard as a bank to make money with a flat yield curve because you need margin spread. So as the yield curve has actually steepened, it's made the outlook for these businesses sort of a lot more favourable. So even though a lot of it has played out, again, when we're looking across the universe, it's still relatively attractive, particularly when you're comparing it to other US holdings, which have become extremely expensive. I wanted to walk through, and we hadn't talked about these positions last time, but I just wanted to walk through a couple of what we're referring to as COVID positions. So when the sell-off happened, we looked to initiate positions and to go hunting in the most stressed areas of the market. So where were there positions where the market was basically throwing the baby out with the bathwater and assuming that these businesses would go bust as a result of COVID? And the idea was that we were trying to find the best of the worst. Worst meaning they're at the pointy end of the impact of COVID. Best, by that what we're saying is businesses that actually had the liquidity and the balance sheet strength to actually survive not making money for a period of time. We took very small positions, obviously knowing that they were high risk positions. And the idea was that we'd actually get set in about 10 positions, on average, hoping that, some of them would make 100% plus. Because the market rebound was actually so fast, because the market fall only lasted 33 days, we didn't get fully set in everything that we wanted to. But we have done really well out of a handful of names that made it into the portfolio. So one, for example, is MGM, which you can see here on the left-hand side. And the green dots are points where we, the first green dot is an initiation of the position. We topped up a little bit, but in general, you can see we've been profit taking and have earned, you know, substantial upside in this particular position. One of my co-portfolio managers has referred to MGM as basically it's exactly the same as a cruise liner, except take the floating element out. So it's got all the same things you get on a cruise ship, but just on land. Probably a slightly different demographic attending. But when we looked at the balance sheet strength of MGM and our assessment of the upside, given how much the stock had actually been punished, we were quite happy to actually take a small stake in that position. Other groups like PVH, which is this was really paired alongside Ridgemount, which we also had. This particular is, you know, what we're talking about here is fast fashion, which in general probably isn't frankly a great business. They've got brands like Tommy Hilfiger, Calvin Klein. There are major brands which are probably not as iconic as they once were, but the balance sheet was really decent. And it was dirt cheap. Even if you factored in some really, really dire scenarios, it was considered, you know, extremely cheap and worth taking an opportunistic position in. A couple of other opportunistic positions was things like Carnival Cruises, which most people probably thought we were completely insane in taking. No, because obviously travel, particularly amongst the older cohort, the idea of being terrified and trapped on a boat, couldn't really get it anywhere worse, right? However, what you find is that people who like cruises don't just like them, they love them. So knowing that, once again, if the balance sheet strength and liquidity was there to survive a period of not being able to make money, that the client base and customer base would likely come back. BMW was a quality play that we made in this space. So again, autos was significantly punished during this period, predominantly because people were assuming that consumer discretionary wouldn't be a thing. However, what we actually found is it was a rather unique recession where consumer discretionary spending actually went up instead of down as it typically does during a recession. So they're just a handful of examples that, you know, when we were running these positions, we made some pretty dire assumptions, but even the extent of the market sell-off allowed us to be comfortable in taking a position. So that walks you through an update of you know, where we're at. I believe we might have a few questions.
Yes, we do, Jody. I'll take them as they came in, and I'll paraphrase the first one. What's our view on the performance expectation in the short term of domestic versus international equity?
Okay, so we have a preference for international equity at the moment. The Australian markets run pretty high. You know, at this point in time. So we actually think there's better valuation opportunities overseas, particularly in Europe and the UK, and in some emerging markets, so particularly Latin America, and we do like Mexico. So for us, we've got a bigger overweight exposure to international than we do to Australia. The other reason why international is beneficial is because of the currency exposure. The Australian dollar is one of the most expensive currencies in the world at this point in time. So having some assets offshore and getting that additional benefit from the currency is quite beneficial as
well. Staying on global equity, an eagle-eyed advisor saw that when, just on the example of BP, the advisor noted that we were selling off at the same price that we were buying in the previous period. So they're keen to understand what changed in our view.
Yeah, let me go down to BP. Yeah, these are, so it can be difficult to sort of decipher what's happening here. We would have had other holdings at other points in time down here, and it's just the way sort of accounting holdings work with regards to sort of, you know, first in, first out. So we have been making money from these positions. But as you can see, on a whole, we dollar cost average as we go in. So the average price that we've bought at is certainly below where we're starting to trim. Now, we haven't sold out. This is just trimming. This is taking into account that this stock has risen 65%. It's prudent that we actually start pulling back and trimming some of that position. It is still one of our preferred positions in the portfolio, but it is approaching fair value, and we need to be mindful of that from a risk management perspective.
Are you concerned about further COVID waves, and what will a delay in the various vaccination programs do to investment markets?
I think that, look, I think the reality is that the next sort of 12 months, we're going to see a lot of volatility in the market because of unknowns around COVID, third, fourth waves, different variants of the virus, etc., until we get mass vaccination programs happening. So at the moment, the last data I saw, which is probably quite dated, even though it's only a week or two old, was at the moment there's just over 500 million people in the world that have actually been vaccinated. Now that compares to the 7 billion people that we have on the planet. So until we actually get mass vaccination, we are going to continue to be at risk of economies actually needing to restrict the movement of their citizens and shut their doors effectively, which can have an impact on earnings from that perspective. So I think it's a risk that is going to play out over the next 12 to 18 months, and do expect a lot of volatility in the markets. We've been saying since the beginning of the year, it's going to be a pretty wild ride from sort of a market perspective, a performance perspective. I think the other factor, and probably the more important one with regards to how markets are going to move, is the way the market is starting to think about inflation. So on one hand, you've got concerns about if we get second waves and the economy doesn't end up being strong, then yes, a PE ratio of 27 is looking really rich. On the flip side though, if we do continue to have markets, economies open up and we get a lot of growth coming through, the market at the moment is assuming that the positive economic numbers coming through at the moment is going to ultimately lead to inflation. Why why they're actually taking current numbers and extrapolating them into the future forever is sort of mysterious, especially given that the Fed has actually been extremely vocal about the fact that they see inflation as transitory and that they will not sort of react from a policy perspective. So they're willing to allow the economy to run hot for a period of time. Now, the reason why that is important is that that then flows through into the pricing of bonds, in particular the 10-year rate, which is used as a global discount rate. So if inflation expectations don't match the reality, you will get a repricing of risk. The way that it won't meet reality is either inflation doesn't happen because people are just being overly bullish about some of the spikes in inflation that we're seeing as supply chains reopen back up is going to be permanent, or if we actually go backwards from an economic perspective, which is that case with regards to that particular question of if COVID keeps flaring up, it is going to be difficult for the economy to get any significant momentum from a growth perspective.
Let's start on inflation for just a moment. How should advisors be preparing their clients for news on inflation, or what should clients be saying to their clients about inflation?
Yeah, it's interesting. I'd be really curious to know whether or not clients are talking about it, because there's two types of inflation. There's actual inflation, so the price of your bread going up and bits and pieces. And then there's inflation expectations, which is really a market construct at the end of the day. I'm not sure how many clients would be thinking through inflation expectations. With regards to actual inflation though, if they have concerns with it, from our perspective, we still think that we're in an overall deflationary environment. We will see pockets of inflation in the short term. COVID caused a huge lockdown, which interrupted supply. Demand, perversely, was not actually interrupted as much during this period because people were at home online shopping. But there was a supply constraint. Now, as economies open up, the laws of supply and demand will hold. There's no way economics 101 goes out the window where that if a producer can actually, capture profits by increasing supply, that they will. So laws of supply and demand tells you that once the supply side opens back up, the prices should normalise. However, there will be a period of inflation occurring. There's a lot of structural reasons, I believe, as to why we probably won't see inflation over an extended period of time, and that's predominantly around productivity and productivity improvements. If you actually have a look at the US, so the US GDP fell during the COVID by 3.5%. Unemployment went up by 5.5%. So technically, the US actually had a productivity increase. Productivity increases are bad for inflation. The other reason why I think inflation structurally is going to be difficult to get within the market over an extended period of time is that, you know, you often hear people talking about the supply of money, and yes, it's important. The supply of money and the fact that the central banks around the world have monetized debt has certainly increased the supply of money. So yes, that is a problem. However, you need two things for inflation. You need increased money supply, but you also need a velocity of money. If you actually have a look at the velocity of money, and you can go onto, you know, the Fed website and use them as an example where they track the velocity of money, it has been on a sharp decline since the GFC. Now, the reason for that is that most of the additional money coming into the economy is actually coming out of fiscal spending, which is monetized by central banks. That actually takes the real banking system partly out of the equation, and you need that real banking system to get the velocity of money to occur. We're also getting diminishing impact of debt. So every time there's a crisis, governments go in and they throw more money out from a fiscal perspective. But the actual marginal benefit of that debt is getting less and less and less, which is why these fiscal bailout packages are getting bigger and bigger and bigger, effectively. So, you know, I would be looking at things like that. Is the velocity of money changing, and where is productivity? Looking at both of those, I think structurally we are unlikely. Short term, yes, because there's been supply chain disruptions. However, these supply chain disruptions should be normalised through the laws of supply and demand that have always played
out. We updated our view on US financials. What's your view on Australian banks?
The Australian banks are looking sort of, you know, expensive. They're a large part of the market. And so the reality is if the Australian market goes up, the banks go up. That's just the way it works because they're such a big part of the market. We do have, you know, some exposure to them in various portfolios. I think from here, they're more of a risk management tool with regards to understanding your performance relative to the Australian market. I think they're quite good in an SMA context because there's something that the clients can understand. They can see that they hold a bank, they know what a bank is, and sort of, you know, that makes it sort of quite beneficial. But again, as I said, banks are going to be beneficiaries of a cyclical tailwind. They're also going to be a beneficiary of a steepening yield curve because it's easier for them to make money in their margin businesses. The Australian banks obviously have, you know, significantly changed their, since the Royal Commission, their overall books, which is probably quite a positive as well.
We are getting close to running out of time, and thanks for sending through the questions. As you're sending them through, I'm going to keep asking the big ones, but if we don't get back to you now, if we don't answer them now, we will certainly get back to you. Very quickly, you did touch a little bit on Europe and car manufacturing and EV. So if Europe is placing more importance on carbon, how do you look at European car manufacturers like Volkswagen, Audi, and how do you see the opportunities in the EV space?
I don't have a good answer for that, to be honest. I mean, obviously the autos have significant upside in them. A lot of the autos are actually looking at whether it be hybrids or full electric vehicles. So, you know, much like the movement to a decarbonised world impacts energy companies, it impacts companies that are selling, you know, emitters being cars. With regards to specifics about the autos, outside of the ones that we've got in there from a valuation perspective, I probably don't have a lot of detailed information that I can provide right now. Something we can come back to you on if I talk to the portfolio manager who looks after that part of the portfolio.
Okay. I think we may leave it there, to be honest. There have been, as I say, there have been a number of questions that have come in, and we will get back to you directly on those. But if there aren't any more that do come in, I think we might say thank you and leave it there. And we'll join you for the next one. Thank you for joining us for this one.
Thank you.